Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. The case for a chat today. China wars continue as FPIs keep out, or could that change? Will the pullback move continue, or rather, will the pullback, or rather, the drops continue amidst a muted Q2? Will cement stocks consolidate further? I think a lot of questions and the answers to some of these with Ajay Srivastava. He joins in right now on Talking Point this time. Ajay, great having you. Thanks for joining in. Ajay, it's an interesting thing. He was talking about how the outflow from EMs like India and some others have gone to China month to date. It's actually not even the Chinese markets which have gotten flows. It's Japan. So what's happening really in terms of global flows, you reckon?
I think one, I'll tell you a little later in November because just after Diwali, I'm traveling to Hong Kong and China. So to get a first-hand feel of what's happening in those markets and companies. So I think I'll be in a better position to tell you. But I think what I can tell you is as follows, that everybody is wary of China at this point of time. And everybody is wary of the results which are going to come out after November 5th US elections. If Trump wins, it's going to be war with China on the economic front. And I think all the FIs, by and large, at this point of time, as I talk to them in the US, are going to wait out to see what happens on November 5th. If Trump wins, is China traders off the table, immediately off the table, and you see a pull out, in fact, of funds coming out of China. If, of course, if Trump loses, you will find that money will start to go back to China. So I think it's going to be wait and watch till the US presidential election. Having said that, it's so difficult to make money in China. You don't know what's happening to the companies, the accounting books. If you read some of the balance sheets of the companies, literally very difficult to understand. And the political, you saw what happened to Jack Ma, the global poster boy. Immediately he's gone back to, I believe, a teacher now. I think that's what I'm told. So I think, given the political imponderable and the US elections, I think one should just wait to see how China plays out and on the contrary, one should wait and see how India plays out because particularly the pharma market of India, if Trump wins, is going to fly like a rocket at the end of the day. So China's story, I think, is wait till the US election and then take a call as to what happens. If Trump wins, of course, it's off. China investment is off the table.
Got it. So, okay. Having said that, the essence, Ajay, that I'm trying to get to is that the way FI inflows have a limit after which they stop. What about outflows? It's not that FIs were seriously overweight India, right? I mean, I think 16.2% or thereabouts was not overweight position in any fashion whatsoever. When does this bout of outflows stop? It's a guess. It's a hypothesis. I'm asking you to make one. When does it stop? And why? And what could lead to it stopping?
See, there has to be a meaningful correction in respect of the share prices vis-a-vis the earning potential. And that's what is holding back and continue to see the outflow is that, how do we make returns on a country where our companies are growing less than 5% and but the P's are at 40s and 50s? Indian companies by and large should be at P's of 15, 20, 25, most of them given their growth trajectories. We are at P of 40, 70, 80, and we see listings at 100 P's and 80 P's and so on and so forth. It's a ridiculous, absolutely ridiculous. So I think if you forget FI, even if you're a domestic investor, a lot of the good investors who are already invested would have not invested too much in the last 6 months in this market. On the other hand, you're finding that the risk issues coming from West Asia are giving gold and silver the boost that they always had. For the first time, I can see the talk chatter when I meet people is no more about equities. Yeah, we missed the gold thing all about. Gold was supposed to be fuddy-duddy. It's what your mother told you. And I'm grateful to my late mother who told me this advice to saying, whatever you make 10 to 15% put in gold year on year at that point of time. There were no gold bonds, so it's buying physical gold. And I think now a lot of investors realize that their portfolios are unbalanced. They don't have any gold, silver in their portfolios. And so you will see in the next 6-9 months that rebalancing will continue. People are going to get out of equities or not invest surplus in equities and try to build back gold. So even FIs are doing the same thing. They're going into commodity, they're going into gold, they're going into silver futures at this point of time. And therefore, this rebalancing has to continue till our share prices become more realistic and realizable in context of our economy and growth. So I don't know when it will stop, how much it will stop, but I certainly believe both domestic and internationally, the big rebalancing into gold and silver is now on its, I think it's on the first big leg of happening. People are now committing larger and larger capital to gold and silver and including debt securities compared to equity market. So balance, it's not just about your equity market, it's also about what's the potential return in gold, silver, and debt securities.
But Ajay, coming back to the conversation, it's an important point you raise, rebalancing of portfolios. Now, the last 3-4 years, people have been all equity, all through and through. Now, let's assume people are rebalancing. There is pain in the mid caps and the small caps in the last few days. You reckon that will continue, or at some point of time, some high quality mid caps will get bought into, Ajay? Because this quarter, Ajay, I've heard dichotomous statements, right? There are companies which are talking about not a great number today, but we were talking to EPAC Durables, an EMS player, who's just told us this morning that from 1,500 crores of revenues in FY24, with a new deal that they've signed with Hisense, he expects to go well over 5,000 crores of revenue by the time FY28. So that's a 3x jump in revenue in 4 years. That's quite stellar, really.
Well, I wish I could be the same, seer who can predict 4 years. Okay, believe me, I can't predict what's going to happen to my life tomorrow morning. 4 years is too long a time. I like to live my life peacefully, saying this year what I'm going to do for my life. 4 years, okay, maybe so, maybe not so. And on all the boards that I work with and I represent, I think one thing I really dislike is CEOs telling me everything is going to be very good 4 years down the line. But you know what? Current year is a problem, dude. You can understand what current year is going to look like. You're going to tell me 4 years is a certainty. Current year is the uncertain element. This is the standard talk that you hear in investor community, in the boards of the companies. Every single CEO tells you the same story. This year I do not know, but third year from now, I will grow at 40%. So I would take it with a pinch of salt at the end of the day. And as you ask the mid cap, see, mid cap stories are meant to be ridden up to a point and then you're off. They are flavors. They are a trajectory point till the price is discovered by the market. Once price is discovered, then your ride becomes choppy, then it's performance driven, then you already taken that. So, so the game of mid cap is all about changing horses, jumping horses. It's not about trying to ride the same horse till sunset comes. That's only happens in westerns where the hero goes into the sunset. In mid cap, if you go into the sunset, you're going to lose terrible money. So I don't know if I've answered that question. The question, really, answer is that if you've ridden a good ride with a mid cap and seeing high PEs, and there's no way the company can grow at 70, 80, 60% in the next 3 years, you need to get off those mid caps and move to a newer stories. Good part, India's IPO has given you a lot of newer stories, a lot of new discoveries are coming into place, and therefore some are good quality long-term stories like aviation, hotels, which give you continuous trajectory. But mid cap, you need to get out of the horse. It's a galloping horse. You have to get out, ultimately book your profits and move on. One in few may go on to become a mega bagger and so on and so forth, but three which can cut you halfway or both can just kill your returns. So my advice always in mid cap is you made a good return, you rode the first ride, second ride, now get off, let somebody else come in place, but you need to find newer horses. It's a tough game, but it's a game of newer horses.
Okay. Fair call. The point well taken. The theme that was expected to start post the new government coming in is infrastructure. We've seen a clutch of order wins, not necessarily very large ones, but decent ones for the mid-sized companies as well. I heard you say mid-caps are a flavor. Are infrastructure mid-cap companies a flavor, or is that something that you're looking at slightly more constructively?
No, we have got investments in particularly two large mid-cap infrastructure companies. We have got investment, and they are primarily debt-free companies. That's one of the key things we look for is if an infrastructure company, you got debt, you got a problem. So I think the first criterion is as long as the company remains debt-free, these infrastructure development companies are going to do well. The moment they load up the debt and they start to take primary risk on the projects, you got a problem sitting here. And look at the other context of infrastructure, the power sector, the end companies which are more robust, which are the, people like NTPCs that I'm not saying recommending any name, but I'm just saying the end power generation companies, the transmission companies, including a REIT, which has done so remarkably well for us in our investment portfolio for years, which is a transmission REIT. I think those are the places where you have better and easier, simpler place to happen with quite a quality return with less uncertainty. So the way I would play infrastructure is go for the power sector on the generation side, transmission side, go for the infrastructure on MNC companies, which have got proprietary technologies to come to India, whether it's in sustainable environment, whether it is railway coaches or engines, and so on and so forth. So I think for Indian infrastructure mid-cap companies, The bar is going to be very high, and our bar is they need to be debt free and growing at 25% per annum. And there are only two companies which have qualified for it so far. They've done reasonably well, but beyond that, I think it's anybody's game that what this company can do, cannot do. Debt will kill these companies, and pure execution companies, civil construction, that's a disaster. You've seen L&T's construction. If L&T is making 2 to 3% margin, can you imagine what a smaller company will do? So I don't think it's a place where you want to put your money. Smaller infrastructure companies, and a lot of them do a lot of civil work, which is a 2 to 3% margin business.
Okay. Well, and what will feed infrastructure is cement. So, you know, let me try and get in, or let me get in my colleague Mihika, who talks about the big cement deal that has been announced this morning, and then we'll get an Ajay Srivastava's view on the same. Mihika, the Ambuja acquisition of Orient.
Good morning. So Ambuja recently in the morning has reported that it will acquire 46.8% stake in Orient Cement. Now the entire acquisition value is at 8,100 crore rupees and will be funded totally via internal accruals. Now the company will be making an open offer for Orient Cement at a share price of 395.4 rupees per share, which is at a 13% premium to yesterday's close, and it would trigger 26% of public shareholding. The acquisition will add 16.6 MTPA of capacity to Ambuja and will take its operational capacity to 97.4 million tons per annum. A little bit about the deal. When you talk about just the cement capacity that Orient Cement has of 8.5, the deal is valued at $114. But when you talk about, when you take into consideration operational capacity, cement capacity, as well as the potential capacity, the acquisition, is valued at $58 per ton, which is lower than the greenfield setup cost of $110 to $120 per ton. A little bit about Orient Cement. Its current cement capacity stands at 8.5 MTPA. It also has ready to implement capacity of 8.1 MTPA and a clinker capacity at 5.6 MTPA. The potential cement and clinker new capacity stands at 6 and 4 MTPA respectively, and the company has presence across Telangana, Karnataka and Maharashtra. When we talk about benefits for Ambuja Cements, well, it helps Ambuja increase its presence in the south and west of India, and it can increase its pan-India market share to 2%. And Orient also has large-size, high-quality limestone in Chittorgarh, which will support the North India capacity of 6 million tons per annum. There's also acquisition will also help improve the overall return of capital of employed for Ambuja Cements. Lastly, when you talk about benefits to Orient Cement, well, the opportunity will improve operational efficiency because of a higher green power mix and domestic coal linkages. It also could lead to a clinker cost reduction potential of 150 rupees per ton, which helps the company achieve its rupees 1,500 EBITDA per ton target by FY28.
Thanks for that, Mihika. Ajay, consolidation seems to be the name of the game here. But the top two are now taking a serious lead over the others. What implications for investors on the space?
Investors is stay out of cement, continue to stay out of cement, remain out of cement. You know, look at the capacity addition in the market. It's an if you look at this economic, it's a purely undifferentiated product. By and large, I don't think you care that your house you bought was made of Ambuja cement or XY Ultratech cement. I don't think you care a damn about it. Quality is almost similar. Its capacities are going up in the market. There's no differentiating aspects to this product thing. It's linked highly to infrastructure, real estate, which is okay, nice, but the capacity expansion, everybody expanding 30, 40, 50% capacity. Where do you take the price up? How do you create a positioning in the market? You know, this is classic, absolutely classic, uninvestable kind of an environment for a product at this point of time. There's so much happening in this country, differentiated products, differentiated new industries, new e-tech companies. Why would you want to go to the old fuddy-duddy cement, which is not going to give any return? It has not given a return in 5 years. It's not going to return in the next 5 years. I can tell you this much. You consolidate, you pay. Why are you consolidating? Because you think you're going to get market share. You're going to get a little bit. The other guy is also big enough. And the best part is all players are big enough. And therefore, each of them can increase capacities. Each of them can price you out of the market. So I think it's one of the games where an investor is always losing in. It's nice sales size for a promoter, but for an investor, I'm not sure it's the right place. There's nothing there for you, my friend.
Okay, avoid cement. That is Ajay Srivastava's call. And standard disclaimer, of course, we spoke about Ambuja's acquisition of Orient. NDTV is owned by the Adani Group. So keep that in mind. Okay, final question, Ajay. In a skittish market, Where is it that you find favor? Could banks do the trick? There are a lot of reports and on that, and HDFC Bank's results yesterday seem to have induced some of the bulls.
Well, it's strange that no one talks about it, but the trigger in the big banks is not, we are not looking at banking as a trigger, is all the other subsidiaries they own, whether it's the AMCs, whether it's the insurance companies, whether it's the life insurance, health insurance companies, whether it's a financial services company. If you look at it, what we see, the net accretion in value in these banks, which are holding companies, literally speaking, will be significantly higher because what's happening down below in the investment companies. To the point, in 3 to 5 years, these will become significant drivers. And hope and hand that someday regulation changes and these become demerged companies. But the game in banking, and it's really the game in top two banks, really speaking, is the underlying subsidiaries which are going gangbusters. You can directly invest in few of them, which are like the AMC of one bank and so on and so forth. Some places you can't directly invest in it directly. But the trick is that these banks, as they become a holding company for something which is growing at 30, 40%, like the AMCs, the insurance companies are growing at 20%. Therefore, lot less is talked about is what's happening to the investment subsidiaries. You saw HDFC Bank is going to come with an IPO of their financial services companies. It's going to be 1 lakh crore. It's not big in terms of their market cap context, but it is significantly large value accretion for investors. So I think it's going to be a good story for few banks who are in non-banking activity in a big way. But will it beat the market? I doubt it very much. Will it be a top stars return? I doubt it very much. Yes, they're a good part of the portfolios. They must be there in the portfolios. But if you can invest directly to the subsidiaries, so be it. But I can tell you one thing, that value accretion will come from below the subsidiaries, not on the banking. These banks are facing a tough call, as you and all the smart investors saying, either give me high interest rates, or I move to capital markets, or I move to gold, as we discussed. So therefore, come match my returns, and then you'll find it. If you match my returns, your loan portfolio has a problem. So banking itself is going through its crisis. You've seen what's happened in the US. All the revenues come from trading revenues. If you see commercial banking, retail banking revenues, almost zilch. What is making money is investment banking, trading revenues. Nothing going to be different for Indian banks. They're going to be very commoditized in lending, but value-added services will pay the premium. But unfortunately, your returns will be suboptimal. Even best is to do an index, you'll make better money than investing in these banks.
That's a valid point. I mean, and India used to be a nation wherein FDs were the holy grail. That is turning, and some high believers have turned, some others might turn as well. Ajay Srivastava makes a telling point. Ajay, so good having you. Thank you for taking the time down. And talk to you
very much.
Talk to you maybe in or around the festive days, Ajay.
Oh yeah, once I come back from China, definitely I'll talk to you.
Sounds good. Thanks, Ajay.
All
and
right,
viewers, thanks
care.
for tuning into this edition of The Talking Point.